Ladies and gentlemen, good day and welcome to the conference call to discuss Marksans Pharma Q4 FY25 earnings con call hosted by Elara Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Bino Pathiparampil from Elara Securities India Private Limited. Thank you, and over to you, sir.
Hi, thank you, Navya. Very good evening to all of you. This is Dr. Bino Pathiparampil, welcoming all of you on behalf of Elara Securities to the Marksans Pharma Q4 and full year FY25 earnings conference call. We have today with us Mark Saldanha, Founder, Chairman and Managing Director, and Mr. Jitendra Sharma, Chief Financial Officer of Marksans Pharma. Before I hand over the call to the management, please note that certain statements made by the management may be forward-looking in today's call. These reflect management's best judgment and analysis. The actual results may differ materially from current expectations based on a number of factors that affect the business. We will begin the call with opening comments from the management, and we will have a question and answer session following that. I hand over the call to Mark. Over to you, sir.
Thank you, Binu. Welcome, everyone, and thank you for joining us for our Q4 FY25 earnings conference call. We sincerely appreciate your interest and continued support for the company. I'm pleased to report yet another year of robust performance, achieving an all-time high in both revenue and profit. Our operating revenue and PAT increased by approximately 21% year on year. We witnessed a positive growth momentum across all our regions, with the U.S. market being a significant growth driver, experiencing a 35% increase in revenue year on year. Our OTC segment reached a record high revenue and crossed a 2,000 crore mark, a testament to our focus and execution in expanding our OTC product pipeline. During the year, favorable market conditions and growth driven by market share gains and new product launches in the U.S. fueled our success. However, the fourth quarter witnessed a slower cough and cold season. For the RX products, price erosion was stable. In Q4, our UK and Australia and rest of the world markets achieved their highest quarterly revenue of the year. The freight cost in the quarter was stable. We witnessed high freight cost in the first two quarters. However, cost stabilized in the latter half of the year. Our strategic initiatives are shaping up with continued focus on achieving a product pipeline. And during the year, we managed to commercialize 58 SKUs and have about 79 more products in the pipeline. In the UK region, we received approval for around 12 products, and we have already filed 18 additional products out there. Our capacity expansion initiatives is advancing, and we have anticipate the operating leverage benefits to materialize in the next financial year. Looking forward, we are optimistic about the outlook. Our track record of consistent growth serves as a solid foundation, and we are confident that our strategic initiatives will continue to drive momentum. As a part of a commitment and enhancing shareholder value, I'm pleased to announce that the board has recommended a dividend of Indian rupees 0.8 per equity share, representing 80% of the face value per share. With this, I would like to turn it over to Jitendra for an update on the financials.
Thank you, sir. In Q4 of FY25, our operating revenue stood at rupees 708.5 crores, an increase of 26.5% year on year, compared to rupees 560 crore in the same quarter last year. Revenue from the US and North America markets stood at rupees 328.6 crores, an increase of 34.1% on year-on-year basis, driven by new product launches and increased market share. UK and EU formulation business grew by 17.7% year-on-year to rupees 274.1 crores. Australia and New Zealand market recorded revenue of rupees 76.5 crores, up by 20.9% year-on-year. The rest of the world recorded revenue of rupees 29.3 crore in Q4 of FY25, an increase of 55% year-on-year. Gross profit was at rupees 383.2 crore, up 32.1% year-on-year. Gross margin expanded by 228 basis points from 51.8% to 54.1% in Q4 of FY25. This was driven by better product mix and low raw material prices. We recorded EBITDA of rupees 125.8 crore in Q4 of FY25, an increase of 14.7% year-on-year. The EBITDA margin for the quarter stood at 17.8%, a decrease of 183 basis points from last year's same quarter. The decline in margin is due to an increase in employee expenses and an increase in R&D expenses in Q4 of FY24. Profit after tax was at rupees 90.7 crores compared to rupees 77.6 crore in Q4 of FY24, an increase of 16.9% year-on-year. EPS for the quarter was rupees 2. Now talking about FY25 financial performance. In FY25, our operating revenue stood at rupees 2,623 crores, an increase of 20.5% compared to rupees 2,177 crore in the same period last year. The US and North America market recorded revenue of rupees 1,237 crores, up by 34.7% on a year-on-year basis and contributing 47% to our total revenue. UK and EU market grew by 9.2% year-on-year to rupees 1,030 crores, contributing 39.3% to the revenue. Australia and New Zealand market recorded revenue of 253 crores, an increase of 15.5% on year-on-year basis. The rest of world market recorded revenue of rupees 104 crores. Contribution from these two markets stood at 9.6 and 4% respectively. The gross profit was at rupees 1,479 crore, up 29.8% year-on-year. Gross margin increased by 407 basis points to 56.4% in FY25. EBITDA for the period was at rupees 529 crore, an increase of 15.3% year-on-year. EBITDA margin stood at 20.2% compared to 21.1% in FY24. The decline is primarily due to an increase in employee expenses due to the headcount additions at the acquired facility in Goa, an increase in freight cost in the initial quarters of the year, and also due to increase in the R&D expenses. Profit after tax was at rupees 383 crores compared to 315 crore in FY24, a growth of 21.5%. EPS for FY25 was rupees 8.4 compared to rupees 6.9 in FY24. In FY25, cash generated from operation came in at rupees 207 crores. The capex during the period was rupees 173 crores, which is in line with our plan to scale up the acquired facility in Goa. We spent rupees 57.9 crore in R&D in FY25, which amounts to 2.2% of the consolidated revenue. We continue to remain debt-free, and the cash balance stood at rupees 704 crore as of 31st March of 2025. Additionally, India Ratings and Research has upgraded the company's long-term debt to IND AA- from IND A+, with a stable outlook, and affirmed short-term debt at IND A1+, enhancing our financial credibility. With this, I would like to open the floor for question and answers. Thank you very much.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Ahmed Madha from Unify Capital. Please go ahead.
Thanks for the opportunity, sir. My first question is on the Teva facility. In the last call, you had mentioned that utilization was sub 20%. It will be helpful if you can explain what is the current utilization or the other utilization for Q4, and how do you see that trending in FY26? A parallel question to that is, there has been hiring for that facility in the last few quarters. Do you see the peak hiring is behind us, or even in the next year, employee cost should inch up further on quarterly basis?
Yeah. With regards to the hiring, obviously we need to hire staff for the growth as and when the facility has to produce more. But that said and done, we are very close to the peak in terms of hiring. There may be a marginal hiring requirements, but that will be extremely small compared to the quantum of hiring that we've done in the last quarter by itself. With this hiring, we do believe our scale up would basically meet with at least 50 to 60% of our capacity growth that we have targeted historically. Today, not in the last quarter, not in the fourth quarter, but in the first quarter, we are trending. We are trending around at 400 crores, which is pretty much half of what we had spoken of 800 coming out of that plant.
Got it. And with this trend and other facilities at higher utilization in the next 2 years, is it fair to assume we reach close to 3,500 crore top line, going by your commentary before?
Yeah, we still believe we are on par of hitting those objectives. Yes.
Got it. And in Q4, we had a very high R&D cost. Obviously, it's a part of the business, but could you give some guidance? What was the nature of the same? Was it because of the increased filings? And how do you see the R&D cost normalizing on a full year basis in future, either in percentage of revenue or absolute terms, whichever way the company looks at it?
I think from an R&D point of view, taking the whole year spending makes more sense than a quarter-wise spending, because it just depends on when the filings happen, when the product bioequivalence cost comes into play and everything of that stuff. So it's difficult to equate quarter-on-quarter justification or balance. But a whole year, I think we will be range bound at what you are seeing. I think Jitendra will throw some a bit more color on that R&D spend.
So last year, we have spent 2.21% of our revenue on R&D expenses. And in the Q4, so if I compare with Q3 R&D spend with Q4, so in Q3 our R&D spend was 11.71 crore, and in Q4 it increased to 23.47 crore. So there was an increase of almost 12 crore in the Q4. And we have done a lot of filings both in US and in UK during the Q4. Moving on, we do expect the R&D expenditure to remain between say 1.9 to 2% on a year-on-year basis.
Got it. Just one more question before I join back in the queue. How do you see the impact of US tariffs on your business? Obviously, everything is premature in nature, but some insights from your side qualitatively and your view will be very helpful. And also in that context, in anticipation of tariffs or otherwise, are we seeing any pre-buying in quarter one?
No, not exactly. There's no pre-buying in quarter one. The U.S. tariff is a universal question. Honestly, I don't think anyone has the right answer for that. We are optimistic that India's proposal of trade, trade balance or the zero tariff recommendations would fly, and even if there is a tariff implemented, it would probably be very nominal in nature. Our Indian delegates are there in the U.S. as we speak, but again, that said and done, it's anyone's guess as to how the tariffs will outplay. My personal view is I don't see a major impact on the tariffs because the U.S. is taking more of a softening stand over time, not taking a hard stand on how they started the tariff play. But then again, that's only my opinion. I do believe that if the tariffs are disproportionate in any nature, it will be passed down to customers and clients, and accordingly it will be then passed down to the consumer or customers thereafter. So I think that clarity has come from all the retailers that tariffs, if the tariffs continue, then price increase would be unavoidable, basically. So basically, the retailers have already spoken out and said that the prices would go up for consumers.
Sure, sir. This was helpful. I'll join back in the queue. Thank you so much.
Thank you. Next question is from the line of Gautam Gosar from Monarch AIF. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question is on the Teva facility. So, sir, basically, I wanted to know how much volume did you do from the Teva facility last quarter in Q4?
So the last quarter, Q4, we didn't do the volumes as expected. We were somewhere around 200 odd million tablets, 200 million units being generated. But this year, this first few months, we are trending around 350 million tablets. So our objective is to cross the 450, 500, come to close to 500 million in the first half, and then look at 600 and 700 million thereafter.
Okay, got it. So we have a capacity of around 8 billion units in the facility. So can you highlight the peak utilization levels where we can reach, and how much time will we take to ramp up this further?
So we do expect to hit 50% of those volumes hopefully within the next 6 months. Ramping up to hit 8 billion units would probably be towards the latter half of the year or maybe early next year. But we do plan to come at least utilize 50% of those volumes within the next 6 months.
Okay, understood. And so what is the capacity utilization for the ex-Teva business?
I didn't get. Could you repeat that question again?
For the other facilities except Teva, like the Goa and the US UK facility, what is the capacity utilization for the combined business for this?
The other facilities are running at around 65%.
Okay. So just to follow up, sir, I think with the existing capacity ramping up further on the Teva facility as well, we will be majorly exhausted in the next 2 years on the current capacity. So do we have any plans to further add any capacity by debottlenecking, or any plans do you have, if you could highlight on that?
Yeah, I mean, it's a good question. Looking at our growth plans, we would have to obviously add facilities maybe after 2 years. But definitely we are always on the lookout because, in pharma, you got to invest today to see returns after 2 years, right? So technically we are always on the lookout for facility expansion. I mean, any new facility that comes our way, we will definitely try to explore those possibilities. Today we don't have anything on hand, or we don't have anything concrete to discuss on that. But we would have to explore new capacities maybe 2 years down the line.
Okay, got it. So we don't have any expansion plans in our existing capacity?
In the existing facility, it is nominal capex now. Yes, from 450, 500 million to from 5 billion to 8 billion, we may need to expand a bit just to line balance everything. But I do believe so. Capex will continue. Nominal capex will continue for the next couple of years for us to debottleneck whatever we believe is needed to achieve optimum capacity in our plant. So that is very normal. It will be nominal in nature compared to the size of revenue being generated. So I think one should expect that there will be some capex, but not to the tune of what we have done in the last financial year.
Okay, got it, sir. So my last question is on our working capital days. So they've gone up significantly, which is leading to the low operating cash generation for us. So if you can allude some reasons for the same and what can be the sustainable working capital days for us?
I'm sorry, you're not audible. I just could not get that question. Could you repeat that?
Am I audible now?
Yeah.
Yeah, so my question is on working capital. So the working capital days have gone up for us, which is leading to the low operating cash generation. So if you could allude some reasons for the same, what can be the sustainable working capital days for us?
Okay.
So, hi Jitendra here. So see, our current working capital cycle is of 127 days. So there is a slight increase as compared to last year, and our inventory levels have gone up. So right now we are in the process of building up inventory because a lot of new launches have taken place during last year, specifically in US, and we need to ensure that we should have at least 3 to 4 months of inventory at any given point of time. So we are building it up right now. In terms of the cycle, optimum cycle, definitely our revenues are increasing. So in absolute terms, we will see increase in inventory and receivable levels in absolute terms. But in terms of number of days, I think it should be very much at the level at which we are at present.
Okay. So it will continue to remain around 125 days on.
It will definitely be in this range. Definitely, yes.
Okay. Thank you.
So if you see our overall levels, our receivable levels are just under 75 days. Inventory, that by nature of business is service oriented, so definitely we don't see inventory levels coming down. So broadly, though we are trying to optimize, but it will remain under within these range of 125 to 135 days.
Okay, got it. Thank you and all the best.
Thanks.
Thank you. We take the next question from the line of Bino Pathiparampil from Elara Capital. Please go ahead.
Hi, good evening again. Mark, we had this target of 3,000 crore revenue in FY26. Are we on track for that?
Yeah, very much, Bino, because we have done 2,600. So we are very optimistic that we are very much on track for the 3,000 crores.
Right. And that will entail about 17% growth in FY26. It's still early, but if I just peep ahead into 27, 28, etc., do you think the 17% sort of growth rate is sustainable, or do you think the size becoming bigger could gradually bring down the growth rates?
No, I think that is very doable. We would like to improve over the 17%, obviously. And we are optimistic that the market dynamics will stabilize. The geopolitical issues will probably settle down. But I think on a conservative basis, 17% is definitely doable.
Got it. And just pushing you a bit on the tariff front, worst case, if some tariff indeed come to apply, say 10% or 15%, whatever it is, how would you be positioned competitively against your key competitor, which I guess is Perrigo? I mean, will Perrigo have a lot of US-based plans, and will they be much better positioned in such a scenario?
So obviously, tariffs being tariffs coming into effect is going to affect U.S. production also, because U.S. is very dependent on all raw material imports. There are no raw material manufacturers within U.S. So technically, all raw materials coming into the U.S. the tariffs will have an impact on that. Cost will go up even whether you produce it in U.S. or any part of the world. With regards to if it is a nominal tariff, I think it is the impact is less. If it is an abnormal tariff, then there will be that will be passed on to the consumers and to the retailers, and the retailers will pass it onwards. I don't believe it will go down that road. I'm quite optimistic that tariffs will be very nominal or not existing moving forward. It's losing a bit of steam because of various. So I do believe that eventually, if tariffs are disproportionately high, then it will be passed on. That said and done, U.S. manufacturing is also not good. The cost of U.S. manufacturing, manufacturers are not insulated or isolated with tariffs. Their cost will go up because raw material cost will go up. So overall, the difference may not be all that great that one would think that, oh, well, if you are a U.S. manufacturer, your cost will be very low. No, that's not the case, because your cost will go up because of the raw material imports. And that, I think, reality is seeping into the U.S. market by itself. So, tariff is never good news, but it is what it is. It's the nature of the beast today, and we just have to tame it or handle it when it comes our way.
Got it. So this year we have seen a compression in EBITDA margin because of all the extra costs related to your new facility, etc. So as operating leverage sets in, do you see a decent improvement in EBITDA margin next year?
So there are two things, Sabino. One is if you are comparing our last quarter has always been low historically if you go through the last couple of years.
Sorry, if I interrupt you, we can talk from the full year perspective. From 24 financial year 21%, it has come down to about 20%.
Yeah. So that is very nominal. I think we will basically be at par, or we would be able to maintain the EBITDA, if not improve the EBITDA. So we are quite optimistic and bullish on those grounds, on the EBITDA front of it. The last quarter, obviously, our last quarter is not the right way to evaluate anything, because last quarter the product mix changes by itself. We come off the cold season and we go into the pain season. There is a bit of a product mix change also, which has an impact on the gross contribution by itself. And yes, there is the timing in terms of the timing may not be right, because we added more people to enhance more capacity and volumes from our new plant. So, but I do believe we will maintain our EBITDA, our historic EBITDA that we have done, but improve on that.
Got it. And finally, one last to Jitendra. Could you put a number to the capex expected in FY26, all inclusive maintenance, debottlenecking, etc., all put together?
So last year, of course, we did capex of 173 crores, and I think this year also the capex we will continue to incur. It will be lower than last year, but I think we should be somewhere between, say, $8 to $10 million overall.
Got it. Thank you. I'll turn back to you.
Thanks.
Thank you. We take the next question from the line of Dhvij Patel from Finterest Capital. Please go ahead.
Hello, am I audible, sir?
Yes, you are.
Yes, sir. Good evening. Sir, my first question would be on the Teva facility. Just wanted to understand what kind of revenues have we, seen from Teva facility in this financial year. I guess we have just seen for 6 months, if I'm not wrong.
Yeah. So this year, I mean, like I mentioned, we are trending at right now we are trending at 40 odd crores, about 35 to 40 odd crores. So we are looking at somewhere around between 400 odd crores, 400 to 500 odd crores. This is the trend as on today.
400 to 500 crores is what we are seeing for this financial year.
Yeah, for this financial year, based on the current trend, obviously it will improve.
Current trend.
But this is what we are. But if you look at, let's say, April and May, like May, for example, we are trending at between 400 to 500 crores.
Got it. And sir, as far as I remember, when we had a conversation, this facility was somewhere going to generate around 1,000 odd crores of revenues for us once it reaches a peak capacity. So is this plan delayed because we were anticipating around 500 crores for this financial year, the last one, which has just gone by?
Yeah, the last one, that approvals, site variations, everything took a bit longer than expected. Not so much as the capex. The capex, obviously, we've invested. The capex, as you can see, we've invested 175 odd crores of capex. So from a capacity standpoint, we are good to hit those objectives of 500 odd crores. And we are trending towards, like I mentioned, between 400 to 500 crores. So I do believe we will be hitting on a trend basis minimum that objective will be achieved. Then when we talk of doubling it, that's where some more capex and debottlenecking will go on. So hopefully in the latter part of the year, we will be moving probably more towards 600, 700 odd crores in terms of the trending part of it, not the actual revenue, but the trending part of it. Now, it is a just by itself. It cannot be cut short and overnighted achieve those objectives because it is all about plant approvals. It's all about product approvals. There are some things which are not within our control, although capex is within our control, but approvals and product switches are not within our control. So those things, you may have a quarter delay here and there, but we are pretty much on target where spending is concerned, where objectives are achieved. I do believe this plant will hit 1,000 crores eventually.
Got your point. And just the question that I actually asked was, how much revenue have we seen for this financial year, FY24, FY25, from the Teva facility?
We did, around 325 crores.
Okay, got you. And the final question would be on the new products, which will lead to higher margin products. Can you please elaborate what are we doing there now? What is the update on that?
So we are launching products literally every quarter, and every quarter we are launching products. So we do believe we will see at least 50 odd products in different segments, in different therapeutic segments, whether it might be cold, whether it might be digestive, whether it might be pain, and some in prescription also. So we do believe we'll be launching very close to about 70 odd products between now and, let's say, September.
Got it. So your growth and the slide of FY25 and beyond looks a bit conservative. I feel we can change that someday in near future.
Yeah, it is what it is. We would like to give a number that we believe is very much doable. Even taking into consideration the geopolitical situations that exist all over surrounding us, we are still bullish and optimistic in expecting that we will hit our objectives.
Absolutely, sir. That's it from my side, and all the best, and thank you so much for taking my call. Thank you.
Thank you.
Thank you. Next question is from the line of Maithili Balakrishnan from Alchemy Capital Management Private Limited. Please go ahead.
Hi. I wanted to understand a little bit about any pre-buy that you are seeing in the U.S. You mentioned that there is nothing much in April per se. But what about the previous quarter? Is some part of this growth because of customers stocking up?
Sorry, I didn't get your question. Could you repeat it? It's not very audible.
Sure. I wanted to understand, somewhat about this pre-buy from the U.S. You mentioned that, there is nothing much which has happened in April. But could you sort of indicate whether anything was happening during this particular March quarter?
Are you saying
in terms
about
of customers wanting to stock up ahead of the tariffs?
I don't think that is a scenario, not in pharmaceutical. There was, when there's uncertainty, people will wait and watch, right? I don't think you could stock up beyond a certain level. Most of these retailers don't keep a lot of inventory by itself. So they are not equipped to stock up or hold inventory because they handle probably 10,000, 20,000 different items. So technically, so there has been no stock up in April, in March. There has been some slowdown because of pricing situations and whether prices will change in the distribution channel. So if nothing else, it has there were talks of recession and everything. So a lot of uncertainty was revolving around the U.S. market. Whether it is the bond yields, whether it's a recession, whether it is, and it all started off with tariffs. So it was all very new in March. It started in Feb, but it was all very new in Feb and March. Literally nobody knew what was going on. So everyone was waiting for a better tomorrow or a better outcome. And uncertainty is never good for business. So I think now in April you saw things being paused. You saw some positive things coming out and some damage control being done by the administration. And then you obviously saw bilateral government discussions happening. Our Indian government is really working hard towards achieving a trade neutral proposal. So technically, I'm optimistic that they will succeed. So we are hoping, obviously, for things to stabilize and only improve moving on.
Got it. But was April more normal, or was April also a bit?
I think April was also a bit more like March per se, but things are getting better. The fag end of April, you could see things getting better because the pause came, the tariff pause came into effect in April, and then.
Got it. And also to understand on the tariff side, right? These are largely fixed price contracts where the contracts have been done for a period of 3-4 years. So just wanted to get a sense from you of, how will the tariffs sort of get passed on to the customer? And, will we be expected to bear a part of it, or, do you think we can, sometimes there is no alternate, right, but to raise the price. But just wanted to get your sense on that.
So eventually, obviously our outlook, because tariff is more like a force measure, right? It is not within your control. It is a government doing. So the contracts do not cover anything of those natures. And I think the retailers do anticipate that if tariffs do come into play. So today there is no tariff, and as a matter of fact, India has got a great advantage compared to the rest of the world, including for products being manufactured in U.S. Today, India enjoys the benefit of being more competitive because U.S. manufacturers are still having the brunt of bearing raw material tariffs, which are coming out from China, which most of the raw materials do come out of China. But if it is a fact that tariffs do not I mean, India, while it is beneficial, if tomorrow tariffs do come into play, it will be passed on. If it is extremely negligible and insignificant, we may not bother, burdening anything. Probably try to get the cost of goods down to nullify it. But most likely, if it is percent or anything above 10%, we will definitely work on passing it down, and we'll still be competitive compared to the domestic manufacturing in the U.S. because they will also have the brunt of raw material tariffs.
Got it. But this would be a force majeure event in any case.
Yeah, this is a force majeure. The retailers have already made public. Other consumables which are not exempted are undergoing. Our tariffs are being implemented, and retailers have already made public statements stating that prices are going to go up because the inventory is being depleted. The non-tariff stock inventory is being depleted, and the new stock will come with tariffs. And for that, it is not possible for the retailer to absorb anything, so they are going to pass it down to the consumer.
Got it. Two questions on the U.S. growth. When we look at it, it is much higher than what the U.S. market seems to be growing at. We have grown like 34% on a year-on-year basis. So just wanted to get a sense of how are we sort of getting this share. Are there any specific new retailers we have added, or just if you could sort of explain it a little bit. And also this growth that we have seen in terms of the rest of the world, is there any particular geography that is driving it?
So with regards to U.S., obviously for size of the U.S. market, the base is extremely small. So when you grow, the percentage looks big because the base is small, and the market size is huge. So literally, the percentage gives you a different picture altogether. But we are taking market share both from product as well as from new retail outlets that we are getting into. So it is a mixed basket of everything: existing products, new products, as well as new clients. But again, our base is extremely small, so we are optimistic of that growth and continued growth for the next couple of years where U.S. is concerned. The rest of the world, obviously, their market sizes are smaller. UK, our market size is extremely small, but we are doing fantastically well. We have a very aggressive growth plan for the UK market also, so we do plan to grow, and those numbers, will start unfolding in a couple of years. But you will see amazing growth coming from our UK subsidiary too. For newer markets, obviously, we are targeting the European market, which for us is still a new market basically, and we are focusing more on those markets now than ever before. So we are hoping that we can get in there. And last but not the least, hopefully someday we'll get into the Indian market also.
That's all from my side. Thank you and all the best.
Thank you. Next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, Mark. Thanks for taking my question. Mark, on the U.S. business, what kind of, based upon the current order book, what kind of revenue scale-up visibility you have for the next, say, couple of years?
So our order book stands at somewhere around 220 odd million.
Okay.
And it is growing, Nitin, but obviously tariff has been a bit of a damper, right? Because people are waiting and watching before they actually. So I think, like I mentioned earlier, uncertainty is never great for the growth part of it. But we are optimistic that we would basically look at a $300 million order book status within the next 2 years.
And
we are targeting a minimum of 300.
So when you say $300 million order book, what does it translate into, say, typically analyzed revenue by when you start realizing those kind of, for example, when you say you have a $220 million order book right now, what does that really mean from a revenue booking perspective?
So, I mean, obviously that's a good question, because an order book, when you get a contract, it takes about 6 to 8 months to to start executing that contract because of the artwork process and everything of that stuff, right? So technically, substantial amount of this 200, nearly around, I would say, 30 to somewhere around 30 to 35 million will basically we will start shipments only in the month of September.
Okay.
So and then balance 20 will probably happen in the month of Feb or March. Yeah. So technically, it takes about good 6 to 8 months to start commercializing and shipments of these orders. And then you are not going to see from day one 30 million being done, right? It's a trending pattern.
Right. But in a typical situation, if you were to just look at, for example, this $220 million revenue, by what time would you be translate to say annualized revenues for you?
So if you look at today order book status, 220 million we'll do next year.
In F26.
Yeah. But if our order book goes higher, then we'll obviously be much in better position to cross that. Then whatever contracts I get towards the latter half of the year that commercialization will probably because all these contracts, these retailers are always 1 year. They always talk of the next year. They don't no longer talk of this year.
Right.
So if I'm getting contracts of this year, it is not for this year commercialization because they always 1 year ahead in terms of planning.
Right. And in terms of the newer order wins that you've been negotiating or talking to clients around, this is more on probably more products with existing clients, or it's more clients with the current portfolio.
There have been a few new clients, but basically it is more products with existing clients and newer products that we are which we are planning to launch also.
Okay. And for our SKU for the business, still, I think we mentioned in the press release that 2,000 odd crores of our revenues of the 2,600 crores is OTC. And so this skew towards OTC for the business will continue as it is, despite our filing some more ANDAs, which that we've been doing.
It may grow, Nitin, honestly, because we are very strong in OTC. So, like I've always said, it may grow, and you may see OTC having maybe 85% over time. Got it.
That's helpful. And secondly, Jitendra, on the for this year, I think we've had some amount of under leveraging of the Teva plant cost, I presume, which has led to this SG&A cost being a little overhead higher than what has been in the past. In your assessment, by when do we start to leverage those costs start to become like more in line the company average? When we start leveraging the Teva plant better, it happen this year or it take another year?
No, it will happen this year. I think in the second half of this year, we should be able to, so our utilization levels definitely will increase. And we will see operating leverage benefits from this year itself, most likely, but from second half of this year onwards.
And once we start getting operating leverage benefits on this newer facility, what kind of sustainable EBITDA margins can the business go back to?
See, I think definitely we can do 21-22% EBITDA margin once this kind of operating leverage gets in.
Okay. Thank you so much.
Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. We take the next question from the line of Viraj Mahadevia from MoneyGrow India. Please go ahead.
Hi, Mark and Jitendra. Congratulations on stable results. Most of my questions have been answered. Quick 2 questions. One, you commented in your presentation that part of the EBITDA margin impact was on account of freight costs. How are you seeing freight costs currently in April and May period, and are you seeing it moderating and likely to be lower for the next couple of months?
Yeah, it has moderated already. So definitely last quarter was a relatively softer quarter in terms of the freight costs. And but yes, the first two quarters of FY25, we did paid a very high amount of freight cost. So if I see freight cost as a percentage to sales, so in FY25 it was around 5% as compared to 4% in FY24. So we ended up paying more in FY25 as a whole. But yes, now it has stabilized, and I think it will come back to 4% in FY26.
Understood. My next question is regarding follow-on to Nitin's question, which is the $220 million of order book mark that you mentioned. So can we read that as $50 million or $60 million by FY26 over and above the base of 2,600 crores that's already been delivered? And then the incremental balance of 160 million spilling into FY26 at 27, in addition to whatever else we win between now and then. Is that the right way to think about it?
Yeah. So when we talk about so the execution, like I mentioned, will start somewhere in September. Obviously, then we talk about trending, because you will not within 5 months or 6 months actually do the entire 50-odd million, because that 50 million is for the full year, right?
Understood.
So it will translate into a proper revenue only next year if you want to look at it from an absolute 12 months revenue point of view. And then today, what contracts we actually are talking about in this year, basically they talk of next year. Maybe some may happen. If you look at pain, normally happens in April. Digestive happens in latter part. Cold happens maybe in September of 26. So it just depends on the product portfolios and the contracts that you actually get. But it shows obviously the strength of the business model, the continuity, and the growth part of it. So when we talk of hitting objectives of 3,000 odd crores, obviously we talk about the US growth, but we also have UK and other subsidiaries that are growing. But US will will continue to be our growth driver to hit those objectives. And then when we talk of beyond 3,000 crores, we anticipate these additional contracts to fuel us to that level.
Understood. Last question is, can you comment a little bit about your cash balances and the intended use for making acquisitions? Have you made any progress there? Are there any advanced conversations going on?
Yeah, so the cash balance is what is stated out there. Obviously, we have increased our dividends to a level which is all-time high for us. But at the end of the day, we were in dialogue with some companies for M&A, and we are still. But those basically fizzled out in the last 10 days. They fizzled out. In Europe, and we continue to pursue European acquisitions. I mean, we have given mandates, and each of those acquisitions are 30 to 40 million euros potential. I mean, if they do come our way, then we need that corpus with us to execute it and to fund that. And we also need capex of around 100 odd crores to 100 odd crores for our plant. So taking into consideration all these transactions that we have on our plate, you're looking at a good minimum 400 odd crores being kept aside only for that. And then the rest is all fueling our working capital and our growth, our aggressive growth strategies that are there to fuel so we don't borrow, we basically are debt free. So working capital will definitely go up based on this aggressive growth strategy that we have in place.
Understood. Thank you. All the best.
Thank you.
Thank you. Next question is from the line of Bharat Shah from Ask Investment Managers. Please go ahead.
Yeah. Hi. Sincere apologies because I could join only after 30 minutes of the call. So apologies if I'm repeating any question. But Trump, for example, couple of days back seemed to have a direct instructions to Walmart saying that they can't pass on or complain about increased cost and they must absorb. Walmart is an important customer, and clearly this kind of items for them to bear the entire burden, given Walmart's relatively low cost, low pricing model, how that is kind of possible. So I'm confused. While I understand the impracticality of the situation, what is going on one end, the tariff being imposed, and all the time vacillating situation on that, plus to expect that the parties concerned will bear the burden. Clearly unrealistic expectation, but that is what it is. At least on the record, that is what is stated. So how do you read about all this? I mean, it leaves me utterly confused as to what is going on.
So the president will do what he believes he has to do to calm situations down or to show the strength of whatever his objectives are. I don't think it is possible to control cost. If tariffs are in play, cost will go up. Some of the tariffs, Bharat, is literally double the cost of the product. So if depends on which country you're importing it. If the cost of a fruit is $1, the tariff itself is $1. So there's no way for retailers to absorb it. So they will have to. The manufacturers or the suppliers are not going to absorb it. They are going to pass it down. And even for clothing and everything, they're going to pass it down. Now the question is for the retailer, if they want to absorb it, it's their call. But it is most unlikely that anyone will absorb it, and they will pass it down to the customer one way or the other. They may not very blatantly mention, oh, well, this is for tariff. They will slowly keep increasing their price and absorbing. I mean, this is what has happened during COVID also, right? All the prices of finished product went up, but they did it. They didn't mention, well, it's COVID and that's why we're increasing prices. They slowly increase their prices, and ultimately their prices are much higher than what it was historically, because all costs has gone up due to COVID. So technically, I do see retailers increasing prices. There's no way they can absorb anything of that stuff. So Trump may want certain things, and he may pressurize certain things, and it's within his purview to do that. But I don't think it is possible to stop it. So unless the tariffs, unless the tariffs are removed or is very nominal, then definitely retailers may say, 4-5% here and there we can manage it. But otherwise, there is no way that retailers will be able to absorb it, and eventually it will go down to the customer, and the customer will bear the brunt. And we are seeing, if you go to a retailer, you are seeing the cost much higher than what it was, even for essentials. So I don't think that's going to stop the retailer from doing what they have to do.
So essentially, Mark, what you are saying is there are four parties involved. Government of America, which is seeking to impose tariff, retailer like Walmart, manufacturer and distributor like you, and the poor, helpless final buyer of the product. You are basically saying that if U.S. government doesn't relent, then no part of the burden will be borne by either the distributor, a retailer like Walmart, or producer like Marksans. The poor helpless customer will be holding the baby in his hands entirely. Is that what we are? Is that practically how it? Do you think it will work out?
It is a reality. It is a reality. Practically, but it is a reality that everyone is aware that the end burden will be the customer itself, and that That realization is not happening with the current administration because they believe their objective is to get production out here in the U.S. and get everything made in the U.S. But it is a fact that that if tariffs do continue, to be fair, they have exempted a lot of tariffs or they paused a lot of tariffs because it was having a direct impact on the cost of product. Even for computers, they paused tariffs from China. So because the computer cost was going up. Cars now costs are going up because all the spare parts are going up. So technically, the car manufacturers have already increased their prices. Literally, it is like 30%, 40% more expensive to buy a car today. So if car manufacturers or dealers are increasing prices, I don't see why Walmart and all will not increase prices when they come into play. Obviously, tariffs are relatively very new. It happened only in the month. Started only in the month of Feb, towards March, you could say technically. And then again in April it was paused, and then again it has come back to some extent or revisited some extent. So there's a bit of chaos and uncertainty happening out there. But at the end of the day, there is inventory in the system, which once it gets depleted, the retailers will have to bear the brunt. And I'm seeing clothing, the clothing industry, whether it's from India or whatever, they have very clearly told the retailers that they cannot absorb it and they are going to pass it down to the retailers. And guess what the retailers are going to do? The retailers are going to pass it down to the customer.
And just one last bit. How much of what we supply to America would you describe is essential that they can't do without? And how much of it is somewhat dispensable category where cost becomes an area of concern that people may dispense with the consumption itself altogether?
So we don't supply any patented drugs or any products that you could term as life-saving, unless there's a COVID happening and people start taking pain. They need something for fever or pain or something of that stuff. So we don't have any patented items, basically to fall in that category that people have to use it and don't have a choice. But that said and done, it is something where when I talk of essentials, I'm talking more on the grocery part of it, right? Those people have to buy vegetables, poultry, or meat, and everything of that stuff. So those costs are going up. So people will definitely need to spend on that first, and then later on medicines. So technically, all said and done, and that's why there's rumors or speculation or doubts whether U.S. will go into recession because of this issue. But I think the government will eventually back off from tariffs, and the intent was good, but the execution was not very great. So the intent was to have a neutral trade arrangement, but the execution was horrible. So that, and eventually they will back off. I do believe they know it's not sustainable.
Sure. No, I'm aware your OTC business is the dominant one in America. It's somewhat reverse in UK, but given the pill popping culture in America and excessive predisposition towards consuming medicines and drugs for any and everything, and given lack of easy access to doctors for most of the things that people have, I think America has become what it has become, a pill popping kind of a society, recklessly I would say, to the detriment of, to the benefit of businesses of your kind. But within what you supply, given the habits and behavior of the society in America, you don't suspect that really speaking, what you to supply can just be dispensed with by the customers. In other words, where prices begin to bite and they say, okay, to hell with it and not to buy some of the medicines. You see that as a possibility? Assuming all this comes to pass.
I hope not, number one. Number two is obviously if the country goes into recession, then it's new uncharted territories for all of us. But I don't foresee that happening.
Sure. And therefore, you believe these 25% odd growth, which is what I had spoken to Jitendra last time, and I had learned. I don't know what you said in this call, but 25 odd percent growth for US, UK, and other territories put together for next 3 to 4 years. Those plans are intact, and those seem to be on track, right?
So the US, yes, I can talk for the US. For the company by itself, we are giving a year-on-year growth of anything above 17.5, 18% year-on-year growth as a corporate. But US market, our base being very small, I do believe it is doable.
So 25% plus for US and Marksans in entirety at about 18 odd percent, 3 to 4 year kind of a top line growth.
Yeah, for the next 3 years, I would like to restrict to 3 years. But
3 years.
yeah, I mean, we are optimistic. Obviously, we've not given a 3-year projection, but we are aiming for that.
Taking into account all the drama that is going on.
Well, it just depends on how you define drama, right? And nobody wants a worse drama. I mean, there are force majeures which are beyond your control, and if tomorrow war breaks out, it's pretty much saying that it's free fall for everyone. But we are still very optimistic based on the current situation.
Okay, fantastic. All the best. You have really interesting spectacle to deal with. So good luck to you.
It's the nature of the beast. We overcome it. So.
All right. Thank you. And thank you, Jitendra.
Thanks, Bharat.
Thank you.
Thank you. Ladies and gentlemen, in interest of time, that was the last question. I would now like to hand the conference over to the management for closing comments.
I'd like to thank everyone for spending their valuable time and continuing their interest in our company. I wish you all the best and have a great day and be safe. Cheers.
On behalf of Elara Securities India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.